Welcome, everybody, to another episode of the Gold Silver Bitcoin Show brought to you by GoldSilverBitcoin.com. We are so honored today to be sitting down with Barry Dawes, who we thank very much for joining us today, of Martin Place Securities. Thank you, Barry, for joining us today.
Pleasure, Justin.
You bring with you a wealth of knowledge, and I know you focus namely on gold, but you have such a command of all of the sort of pillars of, I guess, the world economy. And I want to touch on as much of that as we possibly can. But I guess let's just start with gold, because it did certainly peak up recently. And of course, the sentiment changed very quickly. You can see on Twitter in real time, almost, the way sentiment can change in these markets with one move. And so we see that gold has broken through the 1830 resistance, and you claim that it's now back testing. Can you speak more to this recent gold move?
Yeah, look, it's been a very interesting time in the gold market in the second half of 2021. Now, gold is always interesting. It's never dull. And when it is dull, you've got to work out why. And I have taken the view, which I think is correct, and you can see from the daily market activity, that the gold price has been suppressed, particularly over the last 6 months, and people doing their best to keep it under that 1830. And when it broke above in what I call the bulge, it was pretty severely dealt with and knocked down again. But all the price suppression does is make the gold price more attractive for the buyers. And given that, as best I can understand it, people have been shorting the market through the futures, they will have to buy that back. And the tightness in the physical market, as I see it, suggests that that might be a little more difficult than they perhaps understand. And the way the gold price was sold off, having been looking at the gold market for over 40 years, it was very amateurish, in my view. Now, how anyone can sell $5 or $6 billion of gold in 60 minutes and be amateurish about it is just beggars belief. But that's what it looks like to me. And that also means that the people have to buy it back. It really is important. And because the price has been kept down by these sellers, they have been the only major seller in the market. So when they turn around to buy it back, they won't find another one of themselves selling the gold. In fact, there will be essentially no sellers. So the gold price, when it moves, will be quite significant and quite strong, in my view. So we try and bring this all together, and we look at the sentiment everywhere. We've got the sentiment in the bond market, the sentiment in the equity market, the sentiment in the gold price, the sentiment in the currency markets. And all these are telling us different things. Some are related, but they're really telling us different things. So in the first instance, the bond market has been overpriced for probably 5 years, and the actions of central banks interfering with the market has now left well over $100 trillion of bonds are very, very vulnerable. They've already fallen 15% from their highs in terms of price, and as yields rise across the board. And I expect to see probably another 25% fall in bond prices over the next 12 months. The bond market's a big market, and many players, a lot involved in it, so it can do a lot of back and filling, and it's sort of unlikely to have a collapse. There's too much involved in it, and because bonds by definition are income producing, there's always a game to be played. So the bond market's turned down. The tech stocks have been, again, like bonds, overpriced, and we're starting to see the big stocks come down. The social media stocks look disasters. Amazon looks as if it's going to have a big fall. So I can see a pullback in those tech stocks. It's not a bear market in my view. It's just a fairly healthy correction, because the relative value of NASDAQ against the Dow or the S&P 500 is at sort of at extremes. So we can see that unwind. Now, stepping back, we've got inflation coming through as a result of monetary expansion. But there's some really interesting things that are happening out there. In the first instance, the cash levels that US households have are very high, and we've seen quite strong retail sales. And I'm really fascinated by the housing market. Now, I've been following this as an outsider, if you like, with no experience in housing. But in terms of what it says to me, we've got units now looking at over 1.7 million units per annum. The US needs 1.6 to stay steady, and there's about 7 million units that need to be built. So if you like, the inventory is a 4-year lag, or sorry, 4 years of production lag. So I can see that driving the American economy. I see the retail sales are strong and the cash levels are high, inventories to sales ratios are low. So that's going to drive the American economy, and I think overall the stock market. And the bond market needs to be repriced to really reflect a more normal outlook. So we look at all that, and we come back to gold, and because gold is really the demand for it is driven out of Asia, China and India. So as that demand stays robust, which it is, you've got to think of gold being the metal of prosperity, not of crisis. So I take a totally different view to most gold bulls, and so I see, as the US continues to improve its economy, I think people will buy more and more gold in the US, and I think that will mean that the market will be very tight. And when we throw in that short position, it becomes a pretty strong market for gold.
You mentioned that you can see a pullback in the tech stocks. You don't see it necessarily as being a crash, but more a healthy pullback. And I suppose that might be more of like a short-term view. So I would say, like, let's just say there's like two type views we can look at things going forward in. And the first being kind of short-term, what's going to happen in 2022. And then the other one being longer term, let's just cap it at 2030, because I think that's probably the best we can do. So now,
it's a bit far away from me.
Yeah, but we can take some guesses. So we can even say 2025. But so now, of course, we're talking about gold now looking strong and firming up. And so in the short-term view, could be an effect of the printing that's gone on in the US and other countries, for instance. And on the longer-term view, though, it seems to be like a lack of confidence in the currencies and the central banks to manage the currencies competently. Maybe, to put it simply, the people are worried about inflation, for what, rightfully so or not. So I guess I want to talk on this show about the short-term view and then the longer-term view, and kind of like what you're thinking, how things could play out at a practical level for people. So kind of looking at the short-term view, do you have any comments on gold, like you just touched on, or perhaps the markets generally?
Yeah, look, I think if we just focus on gold, technically we've been through this period of the last 6 months where we've traded in a fairly tight range, and that's quite unusual. I think the breakthrough 1830 has been very important, and that should trigger short covering. So the gold price in the short term should run, and should run quite hard. The gold stock should do the same thing. I mean, we saw the Philadelphia Gold Index XAU jump over 7% on Wednesday, and now that's a big move. Our stocks in Australia were up 11%, or 10, 11% on the index for much of the day before selling off at the end. So there's a lot of pent-up demand, and consequently the volatility, as the volatility increases in gold, the volatility in the gold stocks will increase. And I think that people will be able to make good long-term investments at today's prices in these gold stocks, whether they're in North America or in Australia. So when we look at the other sectors, the tech is overpriced, will pull back, but the energy sector is very much under-owned, and that's very, very significant, very important in the North American economy. And the present administration, with the way they've treated hydrocarbons, is just silly. And I do expect that there'll be changes that take place in America that will bring that back into equilibrium, certainly before the end of the year. The issue with hydrocarbons, whether it's coal or oil or gas or LNG, as liquefied natural gas in the export markets, it's really a matter of supply. And we have really high capacity utilization rates. And it doesn't matter whether we're talking in North America or South America, in Australia, in terms of the suppliers of hydrocarbons to the world, or OPEC. OPEC, in its own position, has very little spare capacities. There's only a bit more that Saudi Arabia has, and Iran, whatever happens in Iran. But most other places in OPEC don't have much additional capacity to increase the supply of oil. And non-OPEC producers have continued to decline with their output. So the energy sector is going to be pretty important, and I think that will tend to keep the S&P 500 performing, reasonably well, and many of these other basic materials. The pharmaceutical stocks just look to be very, very difficult, but I think biotech overall is still it has a very strong future because of the aging of the population and the wealth that's there to drive those sectors. So it's not just a matter of it's not just a matter of what's happening in the tech sector and how that might affect the overall market. There are many other sectors which are very, very important and can continue to grow. I think property and retail still look okay.
What else do people need to know about, I guess, like the markets generally? There's a lot of fear out there. So I sense a lot of fear. I think a lot of in the US, there's a couple of things that have happened that I think, especially the younger population, has never experienced before. So for instance, prices rising in real time, like you go to the store, other than gas, this hasn't happened really. You, except for slowly, you go to the store 1 week and it's meat prices are this, and next week it's that. And I think people have a greater sense of that. And then the second thing being is that people are reportedly experiencing shortages. This isn't really something I've experienced so much. I guess perhaps I have. That speaks to perhaps how quickly we adapt. But there's a lot of kind of panicked reports of like shelves being completely empty, for instance. Now this doesn't so much jive with kind of what you're saying here in the short term, at least how I'm hearing it. You're not quite as pessimistic as some analysts. Is that true?
No, I'm not. I work on the basis of, heed the markets and not the commentators. By taking a view of many markets, whether we're talking about commodity markets, interest rate markets, currencies, foreign markets, you can get a much better understanding of what's happening in the world, and if you overlay the psychological impact or the sentiment impact of what individuals are doing, you can get a better overall understanding. Um, uh, as I've been following the US housing market, I think that that's quite robust and that's quite strong. And sure, the lumber prices up and so on, inflationary pressures there, but it shows that the economy itself is strong. A lot of the supply side issues relate to imports with so many container ships have not getting access to ports on the West Coast. That's pretty important in terms of the supply lines, and certainly labour issues are affecting things. But I see these things can be relatively quickly overcome, and I think that manufacturing capacity can be expanded, and throughput can be expanded to alleviate some of the supply sides. Remember, higher prices are the best thing for higher prices because they bring new supply, and whether it's import or whether it's domestic production, it will come. And as people are concerned about supply and shelves that are empty, they will act upon it. And the US is an economy that allows people to react to it and actually do something about it. So it's not as if you're waiting for someone else to do it. You can actually go and do something about it. So, and that tends to happen very, very quickly in my experience.
This is a basic premise of economics, I think, is that demand precedes supply. Can you speak more to that concept?
Yeah, look, that's basically right. I mean, America's got 330 million people, and it's by far and away the world's largest consumer economy, excluding the numbers in China and India. It's a very dynamic economy. So that demand can spread interstate, it can spread internationally, it can be activated at a local level, within a state level, because all the infrastructure is there for it to happen. And I've just got great confidence in the American people to overcome these issues. You've got big businesses in logistics. You've got big businesses in manufacturing and distribution, financing. So these things will take place in response to the demand.
Why do you have such great confidence in the American economy and the American people?
Well, having watched America from afar and having first visited there over 40 years ago and made many trips to the States, you do get an understanding of what drives America, and that to me is always very exciting. But it's usually self-interest which drives, but in the United States, you have that infrastructure that allows people's drive to be taken up by whatever's around them. As I say, whether it's transportation, distribution, storage, general logistics, it's all available. And so it's just a matter of how quickly the people react. And I think that given the unhappiness with the current administration on so many areas, people are feeling that, yes, I want to take these things into my own hands and control it. And I think that you can find those changes taking place very quickly in the United States. So again, you come back to those bank deposits that you have. Depending how you look at it, you've got several $1 trillion of bank deposits that are available to households that are their household deposits, and so they are available. I think as inflation pushes up, people are less willing to hold cash and more willing to invest it in whatever way they can, in the way people normally do in America. But I can see, I'm a great believer in the issues of electoral fraud in the United States and the way that's being treated and unwound. And I think that that's bringing a lot of confidence to people, because it might be happening slowly, or very slowly, much more slowly than we would all like, but it basically means that it's happening. And the midterms are going to be a disaster for the Democrats. And I think people in America can feel and see the change. Now, I also look at that through the currency. And as gold bugs are talking about the demise of the US dollar as the reserve currency, because of the debt levels and the fiscal expansion, the monetary expansion, I just take the view that you've got to look at a bigger picture. And when you look at the alternatives to the US dollar, you've got the euro, which in my view is far worse position than the United States, and the yen is even worse. And the only thing that's possibly better is the Chinese yuan, but who wants to own that? So the numbers, particularly in Europe, when we talk about energy, are just going to be a disaster. The lockdowns over COVID have just made real problems in Europe, and because you've got such a large public sector in Europe, so many people employed in government or government organisations, there's far less flexibility on actions. Sorry, I've got a new phone. I haven't put the thing on. Just hold on a second. Nice stuff. And Europe, with its energy policies, it's just heading for continuing rolling recessions. It's just going to be disastrous. So the US dollar will stay strong, and I think that will give people more confidence. Or I think it'll give them a considerable amount of confidence. Interest rates are rising and will continue to rise, and bond yields will have to continue to rise, and inflation eventually will stabilize. But more importantly, things will be actually done about it in terms of increasing supply, particularly of energy, and hopefully making the North American, the US labor market even more flexible. So these things are important, and they're reasons why I think people should stay confident.
How do you heed the markets and not the commentators? What actions do you take that people can learn from and employ themselves to understand their world?
Well, yeah, I always find it interesting to think about the commentary that comes with whatever the Fed does. Now, sure, what the Fed does is important, but what I have found is that there might be 10,000 economists, and they've got 10,000 views on what the Fed said and how it's going to affect things. So I tend to put that at the background and look at what is actually happening in terms of tons, whether it's tons of gold or ounces of gold or tons of copper or steel, aluminum, whatever's happening in the raw materials. They are telling you more than what the Fed commentary is going to tell you. If you're watching retail sales, if you're watching what many different sectors of the market are doing, don't just look at the single S&P 500 index or the NASDAQ index. You need to be looking across the markets. Look what's happening in the bond markets. A lot of people don't understand the bond markets, but people should spend time trying to understand what bonds are all about and what they mean. So yeah, it's when you're trying to heed the markets, you want to see what each of these areas are doing, whether it's interest rates, currencies, commodities, equities, housing, and manufacturing output. All these things give you the raw data, and the commentators, generally speaking, are human, and are often operate within their own silos and don't have enough time or understanding to go and look at other parts of the markets which are just as important.
What are you looking for specifically when you're looking at the raw data?
We're looking at whether things go to new highs, whether we're looking at rates of change, if they're slowing. Often, if they're slowing, they're doing what we used to call a growth recession, which is a slowdown before they start accelerating again. It's just experience and trying to understand all the different market sectors and what it really means. Now, it's interesting. People were talking about retail sales being down 1.5% in December, and people being very, very concerned about that. But if you look at the retail sales numbers, they're at very, very high levels. So coming back from that high level is not to be unexpected, and it's not something that you need to be concerned about. If you like, that is a slowdown in what I think is going to be an accelerating time. I do see fundamental changes that are taking place in the US, and I do look at those things as being very favourable. And if people are caught up with the politics, or they're caught up with an individual issue like inflation or bond yields or whatever, you can miss the bigger picture, and you can miss the opportunities.
Do you look at charts? Do you just look at government websites and publicly available data? Both?
Look, the easiest thing is charts, which, and because I look at so many different markets, you've got so many different players. There might be 10,000 economists, but there's probably 3 billion investors out there in one way or another, people who are participating in the market. So we've got to see what people in bulk are doing, not what the commentators think they should be doing. And I always have to be careful that I don't regard myself as a commentator. I'm really looking at the markets themselves and making the comments, and let the markets tell you what's happening.
What's happening, for instance, what's the data telling you about the silver market?
Well, the data is telling me that there's been price suppression there, quite considerable price suppression. When we look at the supply and demand numbers for physical silver, we're looking at deficits. And as new technologies come through in terms of solar and in terms of electric vehicles, the demand for silver will continue to rise, and we're going to see a growth in the demand for silver. So people who are holding the silver price down for whatever reason are encouraging additional consumption of silver or additional demand. And like every market, when it gets to a stage where the supply and demand are out of balance for whatever reason, if you've got artificial supply in terms of futures market supply, that needs to be bought back. So silver has sort of outperformed gold in the last week, and that's been quite encouraging. We need to get silver up to $30, but once it gets to $30 and beyond, I think we will see a very sharp move in that. I like to think that silver will probably be the metal of the decade for all sorts of reasons, and not just because of price performance. When we look at these elements, they all have their individual characteristics, and the characteristics of one particular metal for an application as a pure metal, as an alloy, or as a chemical is quite often unique. And so these things become high performance products. And so silver fits in solar panels, in the use in so much technology, and as well as it's a bacteria side. It's got many features like that. So the value of silver, in my view, is worth a lot more than $30. And silver reached a high of $50 in 1980. So not many commodities are trading at 60% of their value, or in this case, less than 50% of their value 40 years later, particularly when the demand has continued to rise. So silver's got a very, very special place, and I think it should be regarded as the metal of the decade. And I think people who invest in silver for bullion or silver stocks, I think will do very, very well.
So gold stocks and silver stocks, what data are you looking at there, both in terms of individual companies or miners and also the market generally? There is this new Robinhood generation, a lot of young people getting on these apps and very quickly being able to get basically like a dopamine hit by trading. And there's a lot for them to learn. And there's a lot for us as a society to learn too. But for those young people who might be interested in like the gold and silver stocks, like where do they start with the data? And tell us more about what you think about that market over the coming years.
Well, I think if we look at gold and silver, the easiest place to start is the price. And just looking at it, and whatever your technical analysis, whether it's Elliott Wave, which I like, and I follow Elliott Wave, but I'm not an Elliott Wave technician. And I just like to look at the way these metals perform with uptrends, with downtrends, with cycles, with resistance levels. It can be complicated, but because there's been so much suppression of price in recent times, you've got certain patterns which are being established. But once those things are broken, and I think they will be broken quite soon, then the markets will act as they should, and you'll see, I think, quite active markets in gold and silver. Lots of volatility with the bias to the upside. So the best way for people to play that is not if futures and options on futures are difficult, and they're only for the very, very experienced players. Holding silver bullion as coins or bars, I think is a great idea for young people. It's something that they can hold and grow with, purely on supply and demand, and also the sort of long-term debasement of currency, which has been with us and will continue to be with us for a while yet, I think. So, but then when we start looking at gold stocks and silver stocks. In Australia, we have very few silver plays, so we're primarily looking at gold. The things to look at in any investment in anywhere really is the management first. If you accept that gold and silver are good places to be, you want to look at the management of the companies, and companies that have got good long-term track records are usually good players, particularly amongst the leaders. They don't always get it right, as we've seen with companies like Barrick, but they do recover, and they can resume their position as a leading play. So, and in the market that I see, the big stocks are going to be absolutely extraordinary performers, and people have to keep in mind that these companies will be throwing out quite extraordinary dividends, and as gold price goes higher, the dividends will just increase, and the yields on Australian gold stocks at the moment are far too high. The share prices should be much higher than they are, given the relative interest rates that we have internationally and locally. So, people who want to play this market should be in the big stocks first, and then they can have smaller amounts in growth stocks, and they can search that by performance, relative performance, particularly in bear markets or weak markets. The stocks that give out performance in weak markets are usually signs of things going well within them, and shareholders and investors want to increase their holdings. So that's good. Amongst the very small speculative stocks, of which there are many, and these can get dangerous in North America. The Canadian players have made an art of speculative stocks, so people should be a bit careful of those. But if you do enough research, you can find the management and the project that you want to be in. You might be surprised, but they should be a relatively small proportion of your portfolio, because they're the sorts of things where you can make 20, 30, 40, 50 times your money over the cycle. But having 1 or 2% and you make 50 times your money, well, in one of them, that could give your portfolio a real boost. But it's more important to buy and hold the best things that you can find, rather than trying to trade them, because you'll just get caught up with stock envy. You'll be holding your stock, and you'll see something similar double, and you say, "Oh, I'll go and chase that." You sell yours, buy that. Your one goes up double, and the other one falls in half. It's so often the story. So just make the choice, make a wise choice early, and sit there.
And of course, if you have the opportunity to make 50 times your money, then the risk reward means probably you have a higher risk of losing quite a bit of money, or you're taking higher risk. Would you agree with that statement?
No, not at all. Risk is in the eye of the beholder. So the more work you do, the lower your risk. So the more you understand about an industry, a company, a sector, the lower your risk. If you don't do any work at all and work on a tip, you're taking all the risk. So it is possible to identify companies, projects, management teams that can deliver ongoing long-term gains. And in a bull market, which most people under, certainly under 35 would not have seen. So, when a bull market goes, it goes for quite a long time, and the way you win is to choose wisely early, and buy and hold.
So you mentioned earlier that the tech stocks, NASDAQ stocks, looking toppy, tech stocks particularly awful, and social media stocks, you haven't touched on that yet in this interview, but you wrote in your email that they look doomed. Can you speak to social media stocks looking doomed?
Well, I think the issue, when we see the amount of censorship that's taking place in these companies, and when you consider that the censorship has been over the COVID issue, and there are many aspects of this which are unsatisfactorily discussed and debated. For people to be censoring that, I think is very bad. We have issues like climate change, which people are enamored by, but the empirical evidence just doesn't support it. I mean, the fact that we've got a miserable cold summer is certainly not suggesting that the global warming is with us, because it's not. Sea levels aren't rising. So there's a lot of censorship of that in the main players, whether it's Google, whether it's Facebook or Twitter. There's political censorship, and people will not be happy to be part of that. And because these social media businesses are all about people and their response, and then the advertising, and if the advertising falls away, the value of the business falls away. And if it's no longer growing, the premiums, the high PEs that are associated with them, just evaporate. So, and we've seen things like the famous MySpace, which was set up, that was there, did very well, and just disappeared. And you could see some of these other social media businesses doing exactly the same. Twitter has broken through all support levels that I have in technical support, and just suggests to me that platform is doomed. I think Facebook's got real problems. So these are very interesting developments, but at the same time, as we get alternatives, and that's a great thing about the US, you've got the infrastructure, you've got the dynamism, you've got the people who are experienced in managing these businesses. They can quickly move and set up new businesses that have a different business model, one which is attractive to the end user, and will attract advertising and so on. So there's some pretty interesting things underway there, in my view.
And there are alternatives that are online now. Gitter is having a moment. It's popular right now. Donald Trump's launching True Social soon. There's also Parler, or Parlay, I guess is how it's actually supposed to be pronounced. And then there's also what's my favorite, which I think is kind of like the turtle of the race, not as popular as Gab. It's I think one that is out there as well. And there's a lot of controversy around it, but it does seem to be one that is somebody who is sensitive to these platforms and been on these platforms, one platform that is doing a good job building out an alternative. So you also write in your email that ASX XGD Gold Index is breaking out now from July 2020 downtrend. You suggest to buy the leaders. January 2022 is most probably a very important low for the XGD, and the index is at a very attractive entry level. Can you dig in a little deeper to any of those?
Yes, well, I think that I make the point that the Australian gold sector has been leading the gold renaissance, as I've been calling it, over the past 6 or 7 years. we made our lows in 2014, a year ahead of the lows on GDX and the XAU. Australian gold production has been recovering nicely from the lows that we saw a decade ago, and even though our numbers in the September quarter were a bit disappointing, I still think that as we go into 2022, Australia will be the world's largest gold producer, with output from China declining. Some interesting observations there. It just shows how difficult it is to maintain production, particularly of gold. And so companies have to continue to add to their resources and reserves, and these things run out. So it's very, very hard. Now, China's come from about 450 tons. The last numbers I've seen were about 350. I think it's going to be lower than that going into 2022. So Australia should pass. So when we look at the Australian Gold Index, we've got three major stocks: Newcrest, Northern Star, and Evolution. They're in the GDX. These are companies that are growing. So not only are they producing, they're expanding their operations, they're making acquisitions. So they've got good organic growth, they've got good management teams. And now that we've got that 2020 downtrend from July, August broken, I think we can say that the Australian stocks are going to be leading the North American stocks. Now, there are sort of fits and starts in all this, but you usually find that the Australian stocks are leaders globally. And as our index moves up, as I said, we saw the index was up 11% for an index intraday on Thursday, Australian time, after that 7.38% gain Wednesday in North America. It just shows how much volatility there is, and how much pent up bullish buying is there. So, and as I said in my note, many people have got companies which are down 50% from the highs in June, July of 2020, but the $8 gold price is much the same, and the US dollar gold price is not that much lower. So these companies, being organic, being they're actually life forms that they actually grow dependent on the management decisions of the managers. So they can grow, they can die, but they can grow, and you've got to keep in mind that the management is always doing its best to add value to the companies. So we've got prices which are down 50%, but the underlying value, particularly over the last couple of years, when a large amount of capital has been raised by the sector, it's got into exploration. Our exploration numbers are almost double what they were in the last cycle. So we're finding a lot of gold, and so those stocks have got more value than they had in July, August of 2020, but their prices might be half. So there's big opportunity for regaining those price levels and giving good returns to investors.
Any other comments on the gold or silver stocks right now?
Oh, look, I'll just reinforce the fact that many of these stocks are now paying dividends. They've got excellent balance sheets, lots of cash buffer. Most of the debt in the sector has been repaid. There's a little bit of M&A merger and acquisition underway at the moment. I expect that will increase in 2022. And so, yeah, but people have got that strong dividend yield in a market that really can only go higher. So the total returns to investors should be very, very good. And you've got the added bonus of acquisitions, because the big companies need to buy small companies because they can't explore and discover and develop new deposits internally fast enough.
What are your thoughts on Bitcoin?
Look, I'm negative on Bitcoin. I've never been a great fan. There are certain things which I think are very, very constructive about the blockchain, but the fact that we've got so many of these coins and NFTs and so on out there, to me, it just looks like a speculative mining boom. And when things turn sour, most of the things will be valueless, which is unfortunately what happens in speculative mining booms. That's what it looks like to me. And Bitcoin has broken down against gold as gold rises, and I think the attraction of Bitcoin relative to gold is no longer there, given that the price suppression period is over. And I think that there's so many opportunities for governments to impede the development of Bitcoin type assets, and there's the real fear that they'll try and take it over themselves, which at the end of the day basically means that central bank digital currencies will just be total control over people, and I don't think that's going to be acceptable. And that's why I think gold will just become more and more attractive to the people that have tried to seek refuge in Bitcoin.
Any other comments, particularly on Bitcoin versus the gold chart?
Yeah, look, it's, as I say, it's broken down. Bitcoin versus gold, or gold versus Bitcoin, however you want to look at it. And to me, it's only going to accelerate as gold rises and as Bitcoin falls. I see a relatively large relative fall of Bitcoin against gold, and the way it's lining up longer term suggests that 2023 might be quite difficult for Bitcoin. But look, I'm not a player in that market, and I don't look at it closely enough. As I say, I heed the markets and not the commentators. People can be extolling the virtue of Bitcoin and whatever, but let's see what the market actually says, and take note of that.
We've had the honor today of sitting down with Barry Dawes. He is a geologist and the founder of Martin Place Securities. Thank you so much, Barry, for joining us today.
Thank you, Justin. Interesting discussions.
Always. And thank you, everyone, for listening.